I'll try and make it as accessible as possible. I do recognize that there are people out there who haven't studied finance, which is awesome. So please ask me questions at any time. It's likely that if you have one, someone else is thinking it as well. So there is a lot of content here, which I'm just brushing over very quickly. So please ask questions if you want to jump into a topic further. I'll see how I go answering the question. So as Liam said, there's a few question breaks throughout just after the key section. So for those who have a background in finance, I hope you find this equally as interesting. I know when I was studying finance, I can't remember having too much exposure to the private markets or venture capital. And hopefully it gives you a different perspective about, or complementary to your studies and looking at valuation in a different way. So I'll start with business model analysis. So a business model is a company's strategy for creating, delivering, and capturing value. It's important to look at a business model to understand the factors behind a business's viability, so how it works and what makes it tick. So it's a great way to understand the moving parts that influence a business. And again, I'll repeat this. It's core to financial modeling and valuation. You may have heard people describe business models by the common characteristics they share. So B2B, B2C, ad-supported, franchising, e-commerce. So those are just buzzwords that help people understand business by finding common characteristics throughout. So businesses may have multiple business models. Look at Google. They've got Google Ad Search, which is free. Google Suite is a subscription access to some of their services, but they also have a freemium business model where they give away products for free to support other areas of the business. So these frameworks or rules of thumbs are, commonly, sharing the similar business drivers. So if you say this is e-commerce business, it's applicable to businesses across many different industries, but very standard. So businesses selling a subscription service, they'll all be concerned about the customer acquisition costs or churn rates, which is the attrition per period or how many customers they're losing each period. It's interesting looking at different business models, regardless of sector, just how they work and how the value flows through them, to look at their strengths, weaknesses, threats, and opportunities. But in saying that, there are many different templates out there or standard business models, as they say. But it's important to look at each business in the context in which it exists. So it's going to be bound by a different set of factors. So there's lots of different approaches around looking at business modeling or business mapping. This is just one way that I and the rest of the investment team at Beckon initially analyze a business. It's derived from something called a lean business canvas. It's a thought process I use when looking at a business that comes across my desk for the first time, as a way to understand the core areas of the business quickly and how it works. So it covers a lot of areas in a high level and helps identify really important areas where I should dive deeper to know more. So tonight I'll use the word story a lot. It's definitely not a technical word, but it's just a way to describe the business model and where it's going. So where the business wants their business model to go. So the story helps how the business will get there. So business mapping is a great way to look at the parts of the story that contribute to the business operating and growing. So all of these areas help in identifying assumptions for financial modeling. Financial modeling is just a fancy way of, say, forecasting a company's financials. So each line, such as revenues or costs, are forecast from a modeled formula, but I'll come to this later. It's just important to understand the concept that the numbers are influenced by the story. So when I say assumptions, I'm referring to numbers that are input into the forecast, such as your growth rates. An assumption is a number that has been derived from the story. So if a company's got great marketing, a great product, that a huge number of customers want to buy, then it's likely it'll have high growth rates. So growth rates may be lower if the pricing pressure or the pricing pressure could be higher if there's lots of great competing products in the market. A product might be constrained by its market size. There may only be a limited number of consumers who want to buy it. So these are all stories around different parts of the business that can inform what you put into the model. So I'll go through the core parts of the business map and how it relates to analyzing a business from a qualitative sense in the strategy and competitive forces, but then also look at how that's related to the numbers. And I'll try and talk from an investor's perspective in what I look for in strategy sense in the numbers. So the first one is the problem and the solution. So the problem is the pain points. This is the why. It's difficult to sell a product that isn't needed or wanted, but it's not impossible. So, but it really does help to have a really big pain point. You want customers rushing to your store to buy your product because they need it. So it's important to look at how much the problem is costing them. So in a dollar sense, so the problem is costing them. In a dollar sense, a time sense, or inconvenience or outcomes. So what is the value in solving this problem? What is the current solution or solutions out there? How are they meeting the pain point? Does this, does the consumer know they have a problem, or will the market need education? So leading to your solution, this is your what. What are you delivering to the market? What is your solution to their pain point? Does your solution do a better job than competitors? Is it the same solution, just produced more efficiently or branded and delivered better? This is anything around your offering that makes it special. So a good solution to a problem that is received well by your market is said to have product market fit. So product market fit just means that there's evidence that the consumer you are targeting actually wants what you're selling. The characteristics of the problem and solution are critical to the story of a financial model. It's the backbone. So, for example, the price is intrinsically linked to the problem. So what customers are willing to pay, or what pressure is, if there's multiple solutions in the market, what pressure is placed on the price by alternative solutions in the market that are addressing the same problem. So your customers and your channels. So your customers is who your solution is serving. How are you segmenting the market to find your customers? What are their shared characteristics? As I said before, what makes them tick? What makes them get out of bed in the morning? So different business models will have different markets, and that'll also affect your numbers. Is it a mass market product, or is it a niche market product? Is it going to be segmented or diversified across many markets? In special cases like platforms, it could be multi-sided. You could have two markets with different needs being met. And then channels is how you're reaching your customers. How does this product get in front of the customer? Is it through in-house distribution, through e-commerce or bricks and mortar stores? But doing this channels in-house, you may have higher margins, losing costs so going away with costs from delivering the product in rent or transport or distribution, but you may have to wear extra costs in marketing or sales to attract the customers to your business. Using partners through wholesale, retail, partner and websites, you may have lower margins because there's more mouths to feed in the supply chain as the product's delivered to the customer, but you may reach a larger audience. So for example, Uber Eats, many small businesses don't have access to the market that Uber Eats does. They just don't. But they do take a clip of every transaction. So the business must decide, your local takeaway shop must decide whether it's worth accessing thousands of more customers, but losing significant margin on those products. So I'll keep repeating this over and over again, because I think it's going to be the core message from tonight, that the story must be logically reflected in the numbers. So they do talk to each other. For example, the partners or salespeople are incentivized through commission or payments to sell the product. If so, that's an extra cost or clip in your model, but it also positively influences on your growth rates if they're, or the total size of the market. So many Australian businesses do in-house distribution locally, but license their product overseas, which is expanding the product into huge markets, but without the upfront costs of setting up overseas. This is a really important slide. So the competitors is, how are your customers meeting the problem now? So in the story, how are they meeting their needs in the future as well? So if a business says they have a revolutionary product with no direct competitors, there is always alternatives and substitutes. Doing nothing is a substitute. Customers will always try and meet their needs one way or another. If they don't, there'll be a cost incurred in inconvenience or time. And so the solution or competitors doesn't have to always be an exact match. Walking or a bicycle are great competitors. So many markets will have countless competitors, and that's okay. Most markets don't only have one winner. There's more than enough customers to go around in many markets. It's important to look at how much value they're capturing for their solution. It can give you a good idea on pricing, how much the customer is willing to pay or available to pay in certain situations. The level of competition will also help assumptions around your marketing cost. The consumer may need education if it's a new solution without many competitors in the market. But if there's a stronger competition in the market, it'll affect your market share, your penetration, your growth, depending on the footholds or the strength of their product. Competition isn't always a bad thing for early stage enterprises. So solutions can use, as I said before, product market fit. Solutions can use it, competitors with similar products as evidence that they have product market fit to show to investors that their solution is actually wanted by the market. It works really well if your solution is slightly differentiated positively, or you can produce it better or cheaper. So that comes to compelling value. So I like to use it, Beckon, when I'm talking to companies. What's your secret sauce? Why is your business awesome? So it's anything in the business around how it's delivered. Does the packaging look nicer? Is the shipping faster or cheaper? Can you produce it better or more efficiently? How sticky is the product? So will customers subscribe forever, or will they be repeat purchases? Is there more value in the product beyond dollar value? What are the intangibles? How does the consumer feel when they buy it? So we often see it back in that businesses that take responsibility for how their products and production affect the community environment are actually received better by consumers. And two identical products, one's a fair trade chocolate bar versus a non-fair trade chocolate bar for the same price. I assume most people on this call would go for the fair trade chocolate bar. So it leads into it again. Is it carbon neutral? Is it organic? Is it fair trade? How are these businesses relaying that to their customer? Is their brand and is their story amazing? So depending on what the secret sauce is, it'll be reflected differently in the product, and hence it'll be reflected differently in the model. So if it's produced cheaper, it'll be a smaller cost line than competitors. So what resources do the business have to deliver on its strategy to make the story real? Could be physical resources, land, warehouses, shop fronts, printing press, tractor, website domain, platform, anything that really helps the business delivering the offering. Could be intellectual property, brands, knowledge, patents, copyrights, partnerships, trade secrets. Consumer companies such as like Nike and Sony rely heavily on brands, where Microsoft depends heavily on the software and IP they've developed over many years. Human resources is critical as well. So Woolworths in Australia has 170,000 staff, and one of the greatest assets is their workforce. Being happy and motivated to show up every day. Financial resources is often overlooked in this, but are really important as well. So how much cash does the business have? Do they have lines of credit or working capital? So often SMEs will need to pay for orders in advance. High risk with factories. So at least a deposit on the order, or could be the whole order to a factory. Obviously, so often may not receive the products back in Australia for 90 days and then go on shelves. So they may not be, and then after that to a wholesaler may not be paid for another 90 days. So it could turn into 90 to 180 day terms on financing goods. So often there's a gap in the middle where working capital or short-term loans are needed. Another financial resource is options. So it's quite a technical term, but so owning, especially in a startup, often they don't have money to pay staff members, so they give options away in the business or sweat equity, so working for the business. So adequate options or sweat equity on the balance sheet is easy, a economical and easy way to pay staff members and attract great talent to the team. So that's a great resource to have. On the constraints, what is holding the business back at this stage on reaching its potential? So for most startups, obviously it's capital, it's money. But expressing your current gaps to investors is helpful. So as an investor, it's great to see a roadmap of where a business is going to invest for the greatest uplift in growth. It could be key hires, key marketing costs, investing in CapEx to improve processes in business. Metrics and risks are important for helping to support the story that you're building around your business. So the more data we collect, the more informed our assumptions will be in our modeling. So great source of information are competitors or similar business models, as I said before, the B2B, B2C, looking at rules of thumb in those areas, but not necessarily in the same sector or product offering, but also looking at the risks they face. So it's an important factor in business modeling and putting together the story for the future. Each industry is going to have different risk factors, but commonly investors will want to see that you've identified risk and at least thought about mitigation or strategies to avoid catastrophe or any negative impacts. So a few examples: economic risk, conditions may change, exchange rates, credit access, your compliance and regulatory risk, changes in operating conditions and laws can affect the business. Market risk, consumer preference changes all the time. It's great to stay ahead of that. Market research is great. Focus groups, this happens all the time. Things go in and out of style and in and out of fashion. Another common is reputational risk, especially in startups. What is the chance that it impacts from perceived or real negative activity in the business will have on the business? But I'll talk further on risks later, as they are key to determining the story and making the story real. So the final one, bringing this all together into revenues and costs. So where do your revenues come from? Is it usage fees, sales of goods, subscription fees, lending, leasing, licensing, brokerage fees, advertising? So at the most basic level, across all revenue streams, it can be broken down into P times Q, which is price times quantity. Price is easy, it just depends on how you measure the Q. So for basic goods, it's relatively simple, just each unit sold. But it could be the number of subscribers, the number of hours of a service, or a percentage on a transaction. So variables are costs of delivering each unit, For different business models, the variable costs will be different, to deliver each solution, i.e. the materials that go into each item. Or if it's a service-based business, it could be an hour of my time is the wage, and that's your cost of goods. The fixed are overheads that are not directly related or correlated to delivering of the actual solution, but a head office, compared to variable, which could be the cost of packing each item. So the variables move in line with the actual revenue, and overheads stay relatively flat, although overheads do grow over time as businesses get bigger. So revenues less variable costs, importantly, is called gross profit. So a lot of startups have great gross profit margins and gross profits because each unit they sell is profitable without the chunky overheads included. So once overheads are included, it's just called profit. Revenue minus fixed plus variables equals profit. So when revenues equals costs, it's called break even, and then when revenues past that point, it's you're a profit making business. Right, I'll pause. That was quite a lot of information.
Cheers, Isaac. That was like amazing. I've just been texting the SUIIS team, and everyone's saying how like amazing it is. Yeah. So, are there any questions, Slido? If anyone wants to pop any in, feel free. There's one in there now, so I'll ask that. Sure. I'll wait like a minute beyond that. If anyone has any further questions, just pop them in. Otherwise, we'll keep going. How do you equate the revenues and costs if the product is still in development?
If the product's still in development and there is no revenue, it's a pre-revenue business, and that's okay. There's definitely costs. For pre-revenue businesses, normally the costs are R&D, so it's CapEx into the business. It's not equated into the revenue line. You become a pre-revenue business.
Cool. Yeah. Anyone have any further questions? Otherwise, we'll keep going, I guess.
Sure.
Yeah,
so next stage, I'll jump into the valuation theory. This is
sorry. The questions just come in. Sure. Would you be concerned if a startup required sweat equity in the near term to appear viable, at least in the near term?
So using sweat equity, businesses use it all the time. They often still pay salaries, but not market salaries. So topping up, living wage with extra salaries for incentive to compete with, with strong markets. So companies like Atlassian would still offer equity, I imagine, even though they're not a startup. It's just a way to attract talent to their business to, make talent aligned with their offering. So you feel like you're working part of the team. It's just offers an extra upside to attract talent. So it's not a red flag at all. It's very common. It's most startups will offer sweat equity, especially to senior team members.
So okay, let's keep going. Cheers.
Sure. So I'll dive into the valuation theory here a little bit. Be mindful this topic can be a bit dry sometimes, but I'll try and make it really exciting. So the textbook definition is an economic value of a business. In a real world setting, the economic value of a business is what a seller is willing to sell at and what a buyer is willing to buy at. I note that on startup valuations, the true value of a business can only be made real by future executions. So by the future success of a business. So because they're valued on future earnings potentials, value can only be created if the story becomes true. So this means that current valuations reflect the future value or potential future value. So unlike listed stocks, startups don't normally pay dividends because all profits are reinvested for growth normally. So the only return that investor may get is selling their portion in the future for a higher value. So this is called a liquidity event. So think of liquidity when something's flowing in or out. So when something becomes liquid, it can move. So a liquidity event is a transaction where shares are sold, and at this point, value can be taken out. So an IPO is a great liquidity event. So if you invest in a startup and in 5 years' time it IPOs, then there's a liquidity event where you can buy and sell your shares, and you can cash it out as an investor. So to invest in a business, investors purchase shares or equity in the business. Now, the value of this equity is a percentage of the overall value of the company. So what this means is that valuation is the cost of money coming into the business. So a higher valuation, money will be cheaper because for the same dollar amount going into the business, you'll be giving away less equity. So $1 million investment into a $10 million company is 10% equity. $1 million into a $20 million company is 5% equity. So as a startup in general, you generally want to give away less equity So for the same $1 million coming in, a higher valuation, you'll give away less equity. So as I said before, valuation is set by the buyer and the seller, exactly like listed stocks. So where the price is determined by the market. So it's exactly the same in the private market. What a buyer is willing to buy at and what a seller is willing to sell at. And they have to agree on an agreed transaction. So it's a buyer and a seller's market, supply and demand. So from a business's perspective, some considerations on a low valuation. It may give you a harsh dilution for existing investors or founders or whoever holds the existing equity. Giving away too much equity may not leave enough for future investors, or when I said employees joining if they want equity. It may be difficult in justifying high valuations in the future if you want to increase the valuation. If you're raising at a higher round. If you've raised at a low valuation previously, it'll take quite a bit to justify your growth in that time frame. And considerations of a high valuation. You may not attract the right investors, so investors that don't understand the business and are just there for the ride. Time to close may be longer, or you may have difficult raising capital. It also may increase the pressure and expectations, which can cause further difficulty in further transactions if you don't execute or pivot away from your story. So looking at what methods are behind valuation, people take university courses to understand this, so I'll try and keep it at quite a high level. So typically it's a combination of discounted cash flow, internal rate of return, or comparable company analysis and precedent transactions. So these processes all basically determine that the business's value will look like at a point in the future, build a story, but the story is uncertain. So as most startups are yet to create lots of value or are in high growth phases, it's not appropriate to value them like listed stocks or mature private companies on their current revenues or current profits, because it's not an accurate reflection of their potential future value. So using these various methods, a business is valued at a point in time in the future after it's executed on its story and made it real. So 3, 5, 10 years from now, and then discounted at a rate today, reflective of the probability of that story occurring. So when I say discounting, it comes from discounting cash flows. So it attempts to figure out the value of an investment today based on how much money it will generate for an investor in the future. So in this case, startups, a cash flow will be a liquidity event in the future, which is an opportunity for the investors to sell their shares in the company. And hopefully, all things going well, the value of the business will be higher, and you sell your shares for your capital gains. So if a business sells for 50 million 5 years into the future, and you own 10%, you will have a cash flow of $5 million. But this isn't real, and it's a story, and who knows if it's going to actually happen between now and then. So when analyzing the probability of this occurring in the future, investors can take into account the growth potential of the business, the risk profile. So what is the likelihood, the time frame, cash flows further into the crystal ball are more uncertain, potential additional investment requirements to get there into the future. So how can we create a logical story that reflects the future? So we can start by identifying a handful of important sensitivities or variables that can be adjusted to create differing scenarios with differing probabilities of occurring. So understanding the consequences of scenarios on a business is a really helpful tool for strategic planning and risk management. And it's what investors really want to see. So these variables are assumptions or sensitivities, or just the numbers you put in your forecast, which we've identified during the business mapping process. All the factors that influence a business are a story and crucial to getting that valuation right. So the stronger the story, the less risk, the more chance that the future cash flows will be realized. The more information and evidence around the story, the more confidence an investor is going to have, and the more confident that they are going to get a great return in the future. This is not a very exciting slide, but I'll try and get through it. So the rate of return is the future value discounted by it. So the rate that a future value is discounted by is known as the cost of capital. So the rate reflects the required rate of return for an investor at that risk profile. So the deep insights investors have, the more confidence of the story will be able to execute, and the lower risk of investment and cheaper the cost of capital. So from the mathematically minded, this formula shows the basics of what discounting does. So an increase in the cost of capital or discount rate will increase the size of the denominator, which is compounded by the number of periods into the future, and hence will give a smaller present value. So if an investor is locking away their money in a startup for a number of years, it could be getting a stable, safe return in a term deposit or property or even listed shares in that time. So The high discount rates in VC also reflect the opportunity cost of where money could be put into work elsewhere. So your same investment into a startup could be put into a safer asset class, with more secure return profiles. So businesses with different characteristics will have different costs of capital and valuation due to the risk factors associated with those cash flows. So a stable business operating for 15 years with long-term contracts is likely to have a very stable and predictable future cash flow. So the discounted rate / cost of return will be low or valued on multiples of current revenues. But a pre-revenue enterprise is likely to have a high cost of capital, although the valuation may still be high. Potential future cash flows are very high. So you see many tech startups these days valued on extremely high multiples, valuations pre-revenue, just because of their market size is so great and their potential opportunities for growth is infinite. So a proxy for these future cash flows can be used, such as the revenue based on the potential size of the market. So again, another technical slide. So what is the internal rate of return? The IRR is a rate of return or cost of capital, which makes the present value of the sum of the annual cash flows equal to the initial outlay of the investment. So basically, investors use IRR as a benchmarking cost of capital to assess the quality of an investment. I've plucked a few numbers from my experience in the industry in the top right-hand corner. Please do not take this as gospel or use it in an exam. It's just to give an idea of the range of expected returns. Note that the rates used in IRR compound annually, so even small differences can add up over 3, 5, 10 years. A leader venture capitalist in Australia, Blackbird, I've put their IRRs there as well. You can see they have great returns and they've had a lot of success with businesses they've invested in. They also use TVPI, which stands for total value to paid in. It's just the ratio to the current value to the cash injected at that time. So they've been very successful. And that should give you an idea of just the styles of return and what's a great return in the industry. So a key risk in getting the story together is the management. So VC investments are fairly illiquid, which means it's very tough to get capital in and out of them, which means there's not a lot of liquidity events where investors can remove their cash and sell out of the business. So investors must expect to work with management teams for a number of years. Often it could be a 5-year term or longer until it's an exit event. So naturally, one of the biggest questions investors can ask is, can we work with the management team? Is the management team cooperative? Can we trust them to execute on their vision and not run away and change the story, without consulting them at least? So often startups have little tangible evidence of success, with the major mitigating factor of their risk, the quality of the management team. A relevant track record with transferable skill set helps in the team, whether it's in the actual management operating team or whether they have an advisory council or people in their corner, someone sitting on their bench with skills in that area. So forecasting cash flows for long periods can be difficult. Investors may use proxies, comparable enterprises and comparable deal structures as benchmarks for valuation. So if we aim to value a business as a potential business 5 years into the future, it's very tough to be accurate with so many moving parts inside the business and out. So we can compare businesses to others in a similar context using multiples of revenues or profits or other metrics. So an example used a lot in the listed space is PE ratio, which is price to earnings, which shows the relationship between the stock price and the earnings per share. A common one that I use in the private markets a lot is the EV to Ebitda, which is the enterprise value, which is including equity and debt, divided by the total company's earnings before interest, tax, depreciation, and amortization. So basically pre-tax profit in the most startup cases, which is a good way of showing the health of a business and its operations without, and the value it creates before these deductions are made. Australian SMEs are usually valued between 2 to 5 Ebitda, depending on what the business model. Although high growth startups are often valued at significantly higher, depending on the market opportunities ahead of them. Note that scalable startups like Uber often aren't profitable for many years as they're constantly reinvesting for growth. So then, they're obviously valued on revenue and their potential growth through their revenue because they're not profitable at this stage. It's also interesting to note that listed companies trade on higher multiples, so they've got to adhere to pretty stringent accounting and reporting standards, being listed on the ASX. Public companies often have much greater liquidity, or they do have much greater liquidity. Being able to sell daily. You can buy and sell shares whenever the markets are open. Public companies are more accessible to investors Much larger private companies share some of these characteristics, but all those characteristics there show an investor that there is less risk in their investment and less risk that their capital is going to be lost or gone. So valuation considerations for small and early stage businesses. So what are the investor perceptions of SMEs? So they're high risk, high transaction cost, often time consuming due diligence because there isn't a lot of information around them. So compared to a listed stock where there's research reports or it's in the news every day, most of these businesses don't have a lot of coverage on them at all. And you'll be doing most of the work yourself. It's in a liquid asset. So as I said before, it's difficult to get money in and out of them. Long investment horizon. So, most VCs aiming for IPO. It could be 5 years in the future before, or even someone like Uber where it's not non-profitable business. It's a lot of faith that Uber will deliver on profitability. And it's been, 5 years already. Lack of strong governance and transparency. So as I said before, listed stocks do have to report legally to ASIC and to the ASX with their governance and accounting standards. SMEs don't have to do that. So to combat this and address the concerns, a business should, or someone who's pitching it should, build out your bench, get strong advisory board and partners in your corner, develop a strong business model and roadmap, which is key. Understanding your business is so important. Understanding what drives your business, what are the sensitivities that move and change that will drive your business forward, and that leads into getting the right data and information around that, and sourcing the right capital at the right time. And then also, from the Beckon perspective, knowing your net impact. So knowing how your business influences on people, communities, the environment is actually really important to your product design, your marketing, and how your business works. So I think it makes a more robust business and a more informed business. Wow, any more questions?
If anyone has any questions, I mean, there was quite a lot in there. So
yeah, sorry, I've gone quite quickly.
No, it's fantastic. Like you're breaking it down so well. I'm absolutely loving it. Yeah, if anyone has any questions, please feel free to pop them in the chat, or if you want, you can just unmute and ask if that's quicker. I'll just sit here for like a minute and wait.
Yeah, mate, just got a quick question if you don't mind. I was wondering how you would go about coming up with forecasts that are relatively reliable for a company that has no revenue, or even if it's just a proof of concept.
Yeah, sure. So as I said before, if it's got no historical finance, it's just a proof of concept. Looking at similar businesses, not selling the same product, not in the same sector, but that share the same characteristics of their business model. So business that's delivering their product in the same way, producing the product in the same way. But it is really difficult, especially businesses that don't have, as they say, product market fit. If they haven't demonstrated that what you're producing is going to be wanted and needed. So that is really difficult. So trying to use as much evidence around that, whether if you can, you're doing trials or prototypes to see if they're actually doing what the product says it will, and also getting evidence from comparable business models and their traction in the market. I hope that helps.
Right. Sorry. So just to clarify, is that to help with forecasting the actual revenue, Ebitda, etc., or do you mean to get the multiple and do the forecasts separately?
Yeah, so breaking it down to a P times Q, as I said before, or you can go top down market share by penetration. So getting the revenue from that would be, you can either do top down, which is how much your share of the market, or bottom up P times Q. Both will get different numbers, and that's okay. But yeah, just looking at how other businesses are doing it, because there's obviously very limited evidence from a pre-revenue prototyping stage business. It is a big crystal ball, and it's not a science, it's an art. So
yeah, understood. Thanks, mate. Appreciate it.
Hey, Isaac. I just had a question about non-financial metrics. So what are some common non-financial metrics that you would typically screen for when looking at investment opportunities?
Sure, it really does depend on the industry. So we have one at work, Beckon, we've invested in lately, last year. It's a cement filter basically. So at the end of your day, when you're cleaning out your wheelbarrow, you've got you've washed out your wheelbarrow with your water, you tip it out into this filter, and then you can throw it away on site. Before this product, filling out the water bottle, emptying it in the garden, It's got a pH of about 14, so it's highly alkaline. It's got pure heavy metals in it, lead, chromium. So in that specific case, we'll be measuring those things in the business because it actually helps their pitch. So if they're taking their product to councils or to business sites, they will say each time you use this product, it will take out 0.6 milligrams of chromium from entering the soil. So breaking it down individually, getting metrics that are specific to each business is actually useful rather than just saying, you know, it's always great to see your carbon footprint and how useful that is, but across every business, really taking the time to, you know, find metrics that are relevant to the product or relevant to the business or the environment in which it's in, I find is more beneficial for the product. You can always say, you know, across every business, as I said, carbon footprint, diversity metrics across all business are fantastic, but digging deeper in that, you know, per business metrics.
Thank you.
There's a couple questions on the Slido, but might just get to them at the end so we can keep moving. If anyone has any questions, just continue to pop them in the Slido, and you can upvote the ones you want. I guess at a higher priority. Over to you, Isaac.
Sure. So I'll try and get into the summary and wrapping up the theory. So before we build the story, we've got to understand the company's business model and where it stands right now. So what makes it tick? What makes it great? So really, what are the core drivers? So once you have an understanding of the business and how it works, so how it creates, delivers, and captures value, ask yourself, how will these change in the next 3, 5, or 10 years? So this will inform your story. So it's important to look at as much information as you can, understanding the financials, so historicals, and as the question before about what if it's got no historicals, what it's a new product, looking at proxies, so finding similar products in different industries or similar business models delivering different products, assessing the overall market and competitors today, how will yours fit in and what are the forces pressuring your product or your solution, and the perspectives of people involved. It's always good to talk to the consumers, talk to the employees, talk to suppliers, getting as much information as you can. So I know you've got a case study coming up. It'd be great to talk to someone who uses the product or someone who uses a similar product to get their perspective on, you know, do they really need this product in their life? So once you have a story, it's got to be informed by, you know, business mapping and some research. Try and plot the key drivers down against the story components. So this diagram's from a lecture by Aswath Damorian, a professor at NYU. I've linked his presentation if you want to see how the expert presents valuation strategies. It breaks down some of the steps in modeling and factors to the story. You know, is the product selling into a big market? Is it selling into a niche market? Because that'll, as the question before, that'll determine, you know, your market share times penetration. If you're selling into a 1 billion person market rather than a 30-person market, it's obviously going to have huge effects on your business. So looking at the business growth, how much of the market share is gained from competitors? How much of the earnings or capital is reinvested back into the business for growth through sales and marketing? So it's important that you can draw a logical link with some sort of evidence or justification between the story and the numbers. So there's a common saying that I use a lot at work, it's garbage in, garbage out, which refers to inputting numbers without logic, resulting in a model which is just gibberish. So if they don't align or the evidence is contradictory or it fails the pub test, reiterate and compare scenarios. So the process is really iterative. You're always learning and uncovering more information around the business or the industry or the consumer. So the financial model is a living document and it's constantly updated. Right, any more questions before I get into the case study?
Yeah, sorry. We'll quickly ask these two. What's the rationale behind using Ebitda to EV compared to net profit to EV when determining business value?
So enterprise value incorporates so Ebitda over net profit. I think it's very, very similar. Ebitda is just a more technical term that's used very widely and it's commonly placed. For startups using Ebitda or net profit, it will be very similar. It just depends which a lot of startups not really relevant to your amortization, your depreciation if they hold a lot of assets, interest costs as well if they're holding debt. So yeah, it's pretty interchangeable. I think just Ebitda, EV to Ebitda is just a more common lingo and more commonly understood.
Cool. Is a proxy just a comparable company with similar characteristics?
Yeah, sorry. A proxy is anything that you use to, any yardstick that you use to compare. It could be a similar company and a similar business model, and you can look at their revenues or their more specifically looking at margins, so their profit margins or their gross margins, because obviously businesses are going to have different revenues by different size, but generally judging by margins shows, how much they cost per unit to produce their good. Yeah, so proxy could be a business, it could be a transaction, which is a multiple. So, there's a lot of M&A, like merger and acquisition activity lately. And so looking at the multiples that they buy a whole business at. So obviously startups not commonly purchasing whole businesses, but purchasing a whole business in listed space is a good comparable. Understanding they probably will have higher valuations in the listed space. So a proxy is just a word that I use, to take information from another source that you don't already have. Yeah.
Great. Yeah, you want to kick off the walkthrough of the template?
Sure. So I've just made up a business this afternoon. It's pretty exciting. It's called Fluffy Dog Shampoo. They offer a shampoo subscription for dogs through e-commerce. It's $75 a year to have a dog shampoo delivered to your home each quarter. They've got a special ingredient in the shampoo which makes the dog's coat scented and anti-stench for a month. So it's a game-changing and revolutionary product. There's 3.6 million dog owners in Australia alone, so it's got really high growth potential, although it's an early stage business and a high risk enterprise. So I'll just get up my my spreadsheet for now, if I can.
I've just sent the template in the chat. Is that right,
Awesome.
Isaac?
Yep, awesome. I'll just walk through and go through line by line. So it's a template that I've just put together this afternoon. It's a back of envelope template. So when I first start modeling, especially startups, I don't have all the information at hand. So it's just trying to put numbers in and see how they work together with a little bit of evidence to try and see how it fits. So can you see my screen here?
Yep. Yeah, that's working.
So I've broken it down into tabs: summary, which is just an output page; assumptions; revenue; Cogs, which is variables. I'll change that to variables. You should change this to variables as well. It's like the same language that I've said. So summaries, assumptions, revenue, Cogs, staffing, and valuation. So each of these are very important slides, and it breaks down the business into different components. So the whole document is driven off my assumptions page. As you can see, it's quite clear. And I've identified what are the key drivers of this business and how's it going to look. So, it's a new business. It's going to need, the only overhead cost that it's really going to have is staffing and a little bit of marketing spend to build the brand in the market. So I've just had 10% of, 10% of revenue. It's pretty standard in the market. This will change as I get more information around the business. Customer growth rates, this is my current assumptions on them now. Obviously they'll change as I get more. I've done what I said don't do in garbage in, garbage out, but this is garbage looking at these growth rates because I've got no idea. I've got to go away and do my research on comparable business models and look at how they grow over time. But I'm expecting, it's my assumption at the moment, not a very well informed assumption, but assumption that we're going to have high growth in the first few years as it takes off, and then slow down to 10% a year. In saying that, it's a 3.6 million person market, and I hope to have strong growth for strong periods. So the price, $75 a year for quarterly subscription. A quick research and look online. Dog shampoo is roughly $35, which is really expensive. And if you buy that twice a year, you're already making money. So starting with 1,000 customers initially. So it'll be difficult for startups that have 0 customers to start. It's really difficult to start from a blank piece of paper. That's where your proxies come in. And a lot of that is crystal ball. So churn, 10%. This is another back of envelope thing. I suggest that the average dog life is 10 years, which is awesome. And then making that 1 over churn is the customer lifetime. So 10% churn sounds about right. So you have a customer for 10 years on average. These are just put in numbers that I've, again, made up. The cost of goods sold, the cost that will change with each unit of production. So customer acquisition cost, CAC, in the first year will be $30 on marketing. So that means the business spending $30 per customer on marketing, above and beyond just general brand building stuff. So 10% outside CAC, and then $30 of marketing to attract the customer each purchase. $10 of freight and $5 of production. It's a very cheap shampoo. And this is the staffing cost. I think that each staffing member internally can have 2,000 orders per year. So another back of envelope thing, just trying to get the logic working. So 200 selling days per year, and they do 10 orders a day. It's very basic, simple math, but it's the logic that I think is going to happen, and I put it on the bit of paper at the moment. So you can see that this forms the revenue. I get the P times Q, so price times quantity, both existing and new. So the existing each year goes up with the churn rate, so 1 minus 10%, and then the growth rate each year as well. So growing at the rate I suggested each year. So that's your P times Q, and that is your total revenue. For the total cost of goods sold, which is the variable costs, the freight and production each year for each subscriber, so for each unit of subscription, but also the customer acquisition costs only for the new customers each year. So there's your total cost of goods sold. Your staffing costs, very simple. You just got one CEO, one manager who runs his business, and then your sales or relationship managers, which is a simple formula here, which is just total customers divided by the amount of, so total new customers divided by the amount of sales staff per year. So as you can see, it's a slow going business, and it's starting with 1 or 2, but as we get out to 2028, 2029, it's 18, then 33 staff. So it's growing rapidly then, as you'd expect it would, growing exponentially. So all this leads to the summary. So this is all driven off my assumptions page, and it shows how these assumptions can, sensitivities can adjust the business. So this is a back of envelope model with, so when you start doing your startup valuation, you can clear these assumptions and replace with assumptions that are relevant to your business model or the business model. I don't think it's a subscription style business, so you won't have to worry about churn. It could just be a simple P times Q business where you have the amount of units sold each year. The way you can use your assumptions is completely up to you. A lot of businesses actually input the amount of staff because that limits the amount of Q. Like a lawyer or a psychologist actually is a limited number of Q per staff because there's only so many hours in a day they can bill for. So they may have to adjust the price then if their demand is high. So as you can see here, this is a basically P&L forecasting. So your revenue minus your cost of goods sold gives your gross profit. As you can see, the gross margin is growing over time just because it's a subscription-based business, and only customer acquisition cost is used for the new customers, and then legacy customers are just filtered over time and a lower cost, low maintenance customers. The fixed cost here, just your wages and marketing spend. An interesting line here that I've added in is just a sanity check. It's just another rule of thumb. It's your annualized revenue per employee. So just divide the revenue by number of staff. Your rule of thumb is that Facebook is one of the most profitable companies per employer in the world, and they have 500,000 US per employee. But normally, I would say, looking at most businesses, it should be around 150 to 300,000. A great, the more the better, but just how efficient businesses are, that's normally how it works. So my business is obviously getting more efficient over time as we scale up and the overheads become less of a burden on the gross margins. Sure. So I'll go back to my slides now that you've seen this, and you can have a play in your own time. Oh, sorry. I'll just go back to the valuation section. I missed that. So this is a very simple valuation. So the Ebitda multiplier here, which I've used. So I'm multiplying it by, so in 2029, it's got a revenue of 9 million. Ebitda margin of 21 is roughly $2 million in pre-tax profit, which is, I've used Ebitda interchangeably here because in this model it's a back of envelope. So times by 10. Normally small businesses in Australia will trade on 4 to 6 times Ebitda. That's just a solid business, and it's not growing that. This is a shampoo business. It's not highly scalable. It's not it's not Atlassian, or it's not Uber. It's a shampoo business. So I think I'm being quite generous here, giving it 10 times Ebitda, but it just makes the numbers work nicely. So I've discounted it back at 30%. Remember, this is discounting back, compounding annually for 6 years, back to 2022. So that gives 19 discounted back at a factor of 30% IRR. for this period gives a valuation of $4 million, and that's pre-money. So pre-money means it's a valuation before an investment. So the required capital here, you can see the required capital. If I delete that, that's right, let me delete. But if I delete that, this flows through here, and you can see that it needs roughly $2 million to make the business float. It goes under. This does go under. I've chosen 2 million exactly because it's a clean number, but the model suggests that it actually needs 2 million and 9,000 to make it have no capital constraints. So adding in the $2 million, the post money becomes roughly $6 million. So if the equity investor will take a third of the business at this stage.
Awesome.
I'll just go back to here. So this is the example here, putting it back into just a simple slide. So how I did this valuation, started with the revenue in year 6, looked at the Ebitda in year 6, so $2 million, 10 times that Ebitda margin, $20 million valuation, discounted back to today at 30% IRR, and then the valuation post investment, $2 million. So, look, very, very simple. There are a lot more moving parts to this, and this business is a bit of a fantasy, and I personally wouldn't invest my money in it into a dog shampoo subscription with basically no traction at this point. But it's a good example, and the numbers work quite well. So on the founder's perspective, a $2 million investment dollars here, for 33% of the business they're giving away. But although giving away business, their pie is still growing. So having 67% of 20 million is a lot better than having 100% of 4 million. So the narrative and the story of the investor will jump on board with the business and hopefully execute on their vision to get to the world's greatest shampoo subscription for dogs. Sure. And that's all I've had today with the content wise. Yeah, really welcome any questions.
Yeah, that was like amazing. I think everyone was able to learn quite a lot through that. Yeah, if anyone has any questions, again, just pop them in the Slido. There's a few to get through. For valuing startups, should you be utilizing SOM in your valuations? If so, how?
Yeah, sure. So looking at your size of the markets is really important. For pre-revenue businesses as a proxy as well. So it's a proxy. You can say we think we can have this percentage of this market. It's a proxy. Yeah, it's definitely important to add in there as much information as you can get around your markets and your customers and your growth potential, especially when you're pre-revenue. The more information you can get together, the better.
Why is Cogs in assumptions as well as on its own sheet?
I think the Cogs in there is the assumptions that I put in there. So the Cogs is per unit Cogs is the assumption. So how much it costs to produce and how much it costs to transport. And then on its own sheet, it's just the working of Cogs times Q. So the cost per unit and adding up over time.
Gotcha. Also, yeah, by the way, if anyone needs to head off at 7 o'clock, so feel free. I might just finish off these questions with Isaac and then we can knock off. It's recorded, so we'll upload it up into Notion and you can all have a look. Is churn only applicable for subscription-based business models?
Yes, churn is only applicable for subscription-based business models, or recurring revenue business models as well. So you may have repeat customers. It's slightly different to churn in looking at that. As how many customers have a repeat rate, but subscription, you could be an energy retailer or you could be a SaaS provider. There's all different types of subscription-based business models.
Great. Just before everyone knocks off, I might just mention that Beckon has a couple of internships open at the moment. One is a research intern, which you can find on LinkedIn, and the other is a marketing comms intern, which I will send in the chat, I guess. That for the comms one, that's just the PDF, isn't it? Is that going on LinkedIn?
I think so.
Oh, it is. Okay.
I can put it up.
Okay.
I'd just like to say thanks everyone. It's been great to present to you guys tonight. If you have any more questions, yeah, feel free to send them through. I'm available.
Awesome. And just one final question. Is the IRR essentially based off how risky the product is? i.e. if it's pre-revenue and without product market fit, it might be like 50 or 60%.
Yeah, so the IRR is just the rate that makes it head back to the original value. So it's, if I put in a $2 million investment and the valuation is at this point at that time, it's just the discount rate that gets back to the original value. But the cost of capital is the return required by the investor at that rate. So the cost and capital and your discount rate are inextricably linked. So the return and risk are linked. So it's the cost of capital at different risk profiles is to satisfy the investor's return. So if you're investing in a bank deposit at the moment with 0.1% interest rate, it's reflective of the risk. But if you're investing in a startup with pre-revenue, with no product market fit, with a poor quality team, or a still learning team, your interest rate, your cost of capital will be significantly higher, just reflecting the loss of capital risk.
Yeah, gotcha. So for like a very kind of sturdy listed company, it might be like 2 or 3%. Like it'd be really low.
Yeah.
Yeah. Okay. Gotcha. Yeah. I mean, that's all the questions. And I mean, I don't want to use any more of your time, Isaac. So yeah, it's a massive thank you from all of us. I think yeah, that was fantastic. And yeah, I'll upload this video later tonight, I guess. And you can all watch if you missed any of it, or rewatch if you want to make sure it goes into your head. Cheers, everyone, and best of luck with the competition.
Yeah, thanks for coming, guys.
Thank you.